Dear patrons, welcome to the latest edition of our monthly market commentary. Global markets witnessed a dramatic shift from risk-off to risk-on sentiment. The escalation in the Middle East initially pushed crude oil above $80 per barrel, sparking inflation concerns. But by month end, a ceasefire between Iran and Israel reversed this trend. Oil prices settled near $67 per barrel, calming markets and easing inflation expectations. In the US, economic data signaled a slowdown. Q1 GDP contracted slightly, the first negative print in over 2 years. Despite inflation remaining above target, the Federal Reserve held rates steady and hinted at potential 2 cuts in the second half of 2025. Consequently, the 10-year US Treasury yield fell by 20 basis points, and the US dollar index dropped to a 3-year low, paving the way for renewed FII flows into emerging markets. India stood out amidst this global backdrop. In the face of renewed fears of a global slowdown, we reiterate our conviction. India continues to stand out as one of the most compelling investment destinations globally. So let's take a closer look at the global and domestic developments that defined the month of June. Global market update. Globally, investor positioning realigned as risk appetite recovered. Gold briefly touched record highs but retreated as sentiment turned. We believe this pause is temporary. Trade wars, geopolitical tensions, and central bank purchases could support gold prices through the year. US equities ended up generating 4.2% returns in the month of June, while European markets underperformed, reflecting regional divergence. NATO's summit in The Hague marked a strategic shift. Member nations committed to raising defense spending to 5% of GDP by 2035, signaling reduced reliance on US security guarantees. India's strategic positioning. India continues to attract flows in the risk-on environment and trades at a premium valuation to MSCI emerging markets. But this is backed by fundamentals, not only sentiments. India offers the highest EPS CAGR among major emerging markets and maintains a robust forward return on equity profile near about 15%. FII ownership remains light while domestic flows have steadily risen. In a world recalibrating for US-China fragmentation, India presents itself as a neutral, scalable, and resilient anchor. Domestic macro update. India's macroeconomic backdrop improved further in the month of June. The RBI's easing cycle is likely to benefit rate-sensitive sectors. GDP growth of FY26 is projected at 6.5%, supported by easier financial conditions and rural tailwinds. Inflation remains benign, aided by surplus monsoon and stable food prices. Rural demand is set to rise and signs of improving job creation is visible. Externally, the trade deficit narrowed and the INR held steady. While the India-US FTA faces delays, India-EU talks are gaining traction. Portfolio positioning. Our portfolio remains focused on domestically oriented, fundamentally strong businesses. We favor financials, including select private banks and PSU banks, and NBFCs in housing and SME lending. Domestic pharma over export-oriented peers. In the energy space, we like gas distribution companies and select oil marketing companies. Insurance and real estate are expected to benefit from rising demand and rate cuts. We also like autos and discretionary consumption, especially two-wheelers, select passenger vehicle OEMs, and value-focused discretionary players. On the other hand, we remain cautious on export-oriented sectors like IT and export pharma, given soft global demand and weak dollar. We continue to like key themes like China Plus One and global supply diversification, rural recovery and affordable consumption, rate-sensitive plays, Make in India and digital infrastructure, defense exports and energy transition. In conclusion, June showcased how markets can swing from calm to chaos. We expect this volatility to persist, driven by global macro and geopolitical concerns. Our strategies are well positioned to navigate these fluctuations and ride on India's structural resilience. Volatility, in our view, presents an opportunity to accumulate high-quality, growth-oriented companies. We remain committed to our focused investment philosophy, a disciplined framework to identify and capitalize on compelling opportunities. Thank you for your continued trust and support. We look forward to connecting with you again in our next monthly update.